Hello everyone, and welcome to my channel. Today, we'll dive into a very exciting and critically important topic in the journey of financial investing. That is, how whales and institutions quietly accumulate stocks and Bitcoin, and how individual investors like us can invest effectively, avoid risks, and grow our assets sustainably. Please listen carefully from beginning to end, as every section contains strategies used by professional investors. Who are whales and big institutions? In the investment world, whales refer to investors who own extremely large amounts of assets. They have the ability to strongly influence asset prices with just one large buy or sell order. In the stock market, these can be large investment funds, financial institutions, or institutional investors. In the crypto market, whales are often wallets holding thousands to hundreds of thousands of bitcoins. A single move from them can trigger either panic or excitement across the entire market. 2. How do whales and institutions accumulate assets? 1. They never buy when prices are surging. The first thing to understand is whales never buy during market euphoria. On the contrary, they wait until fear dominates, when prices drop deeply, when media coverage is negative, and when small investors panic sell. That's when whales quietly accumulate. For example, in the Bitcoin market, when the price dropped from its peak at $69,000 to $20,000, many small investors panic sold out of fear. Meanwhile, whale wallets steadily increased their BTC holdings. 2. Accumulating through many small orders. To avoid being noticed, whales usually divide their buy orders into small parts, executed over an extended period. This way, they avoid creating sudden price spikes and reduce attention. For instance, an investment fund that wants to buy $100 million worth of stocks will not buy all at once, but instead divide it into hundreds of smaller orders, spread out over multiple trading sessions. 3. Creating a sideways accumulation range. Whales often cause the market to move sideways for a long time, forming an accumulation zone. This is when small investors lose patience and gradually sell, while whales quietly buy in. The market shows little volatility during this period, while trading volume gradually increases without significant price gains. 4. Using media and news to manipulate sentiment. Whales and institutions may coordinate with media outlets to release bad news that scares investors into selling cheaply. Right after, they step in to accumulate. Once they've bought enough, they begin to push positive news or impressive earnings reports to drive prices up. 3. Signs whales are accumulating. 1. Price moves sideways, but volume steadily increases. This is a clear sign that big players are buying. When the price isn't rising significantly, but trading volume keeps growing, chances are whales are quietly accumulating. 2. Large wallets increasing their holdings. In the crypto space, you can track large wallets through websites like Whale Alert or Glassnode. If major wallets are continuously increasing their BTC or ETH holdings while prices remain steady, that's a clear indicator. 3. Negative news floods in, but prices don't drop further. When the market is bombarded with bad news and the price holds steady, it could mean strong buyers are supporting the market and not allowing further drops. 4. Spikes in coin withdrawals from exchanges. When whales accumulate, they often withdraw coins to cold wallets. If you notice a sudden increase in BTC, ETH, or major coin withdrawals from exchanges, it could be a sign of accumulation. How do whales push prices up after accumulating? 1. Creating bullish waves with positive news. Once accumulation is complete, whales begin generating a bullish wave using positive news or triggering FOMO, fear of missing out. Prices will start to rise steadily, enticing retail investors to jump in. 2. Amplifying media to drive prices quickly. At this stage, the press, social media, and market analysts continually release encouraging articles and investment calls praising the potential of the asset. Stock or Bitcoin prices can rise sharply in a short time. 3. Gradually distributing as FOMO peaks. As more people pour into the market, liquidity soars, and prices keep setting new highs. Whales begin to sell off gradually. They don't dump everything at once, but exit slowly and quietly while the crowd is still euphoric. V. What should individual investors do to invest effectively? 1. Don't chase FOMO or buy during hype. Golden rule: buy when others are fearful, sell when others are greedy. Don't wait for a strong uptrend to join in. Learn to be patient, observe accumulation signals, and enter when the market is dull. 2. Follow the behavior of whales and institutions. Spend time studying on-chain data, large fund flows, and company financial reports. If you see smart money flowing in, prepare your strategy in advance. 3. Always use stop-loss and manage capital. No one is right 100% of the time in the market. Therefore, always set stop-loss orders to protect your capital. Only invest what you can afford to lose. Don't borrow money to invest. 4. Accumulate during sideways markets. When the market is stagnant, that's the best time to accumulate gradually. Divide your capital into multiple entries. Don't go all in at once. This reduces risk and increases the chance of getting good prices. 5. Don't invest emotionally. Don't invest just because of a positive article or an inspiring video. Base your actions on technical analysis, smart money tracking, and a clear plan. 6. Understand the intrinsic value of the asset. Don't just look at price. Study the project, company fundamentals, team, and real-world use. An asset with real value will eventually rise in the long term, even if it's temporarily suppressed. CS. Conclusion. In the world of investing, understanding how whales and large institutions accumulate is the key to smart investing. They are the ones who steer the market, and if you observe carefully, you'll see the trail they leave behind. As individual investors, the most important thing is to not let emotions take over. Learn to wait, analyze thoroughly, and always act according to a plan. Don't fight smart money. Follow them. But do so earlier than the crowd and exit before the crowd gets trapped. Thank you for listening to today's entire presentation. If you found this video helpful, don't forget to subscribe to the channel to support me and motivate more insightful content on investing, finance, and market strategy. Wishing you successful, safe, and efficient investments.